what attracted me to this space was the contrarian nature of it, the fact that it's a pretty old industry without too many young, ambitious people working in it. And I think it's a very wide playing field for those willing to take the long-term approach.
Hello viewers and welcome to the Assay TV. Today we're in discussion with Matt Geiger, who is the fund manager of MJG Capital. Matt, thank you for joining us. Let's start with a quick insight into your fund, Matt, and please also tell us a little bit about your background and how you got started investing into mining.
Absolutely. Well, pleasure to join you, Adam. Thanks for having me on the program. I'm actually joining you from Virginia City, Nevada, which is the location of the Comstock lode, which some would argue is the most prolific precious metals district in North American history. In our most recent investor letter, sorry to diverge a little bit here, but the featured investment for the letter was Tonneau Gold. And I'm sitting right now in Comstock Mining's headquarters. Comstock Mining is the partner of Tonneau Gold on the Comstock asset, at least the part of it that's within Story County. So first time out of the Bay Area where I'm normally based since this COVID craziness began. So it's nice to be back on the road, even though I'm trying my best to stay safe here. So to get to your question, I'll start with the fund. It's pretty simple. It's a long-term natural resource investment fund. We're very heavily weighted to mining at the moment. Say 85 to 88% of the portfolio right now is mining focused. But we also have agriculture, water, forestry, aquaculture, and other types of protein that do fit within our mandate. And as the commodity cycle continues to mature here, we might see some different tactical allocation decisions. But for now, I'm very pleased with how we're positioned, kind of where we are in the mining cycle right now. Structure's pretty plain vanilla. We have about 30 limited partners. It's a smaller fund. I've asked for a 10-year lockup on all investments. So that's a very, very draconian ask. I like that because it's self-selecting for patient capital. I want investors that are willing to, stick with it through the ups and downs of the cycle. And even though that does constrain the amount of capital we can raise, we're definitely not a location for hot money. That's fine with me. I own roughly 20% of the fund myself. Potentially doing a capital injection here that could take that closer up to 35 or 40%. So for me, it's really I want investors involved that are on the same wavelength, willing to be patient through the cycle and back high quality projects and high quality people. You asked how I got involved in the space. That's kind of a whole nother discussion on its own right, but I can say quickly, I don't have any mining background in the family, which is a bit unique in this space. I will say there aren't too many younger guys, period. And the younger guys that are in the industry generally had a father or a grandfather that were making waves. For me, I grew up in Silicon Valley in the heart of tech country. So it really couldn't be further from the mining world. Ironically, 150 years ago, I would argue that San Francisco area was the mining capital of the world. That's certainly not the case now. It's viewed as a dirty, stodgy, old-fashioned industry by the VCs and the tech participants. I personally think that's BS. None of the stuff being invented in Silicon Valley right now would be possible without the metals that we're pulling out of the ground. Just look at an iPhone that has 36 different metals in it to make it function. So what attracted me to this space was the contrarian nature of it, the fact that it's a pretty old industry without too many young, ambitious people working in it. I think it's a very wide playing field for those willing to take the long-term approach. And additionally, the cyclicality and the volatility of the industry appeal to me. Most people get scared away by volatility and cyclicality. We have both of those in spades in the space. To me, I think if you have the right temperament, the right stomach for it, you can turn those to your advantage. So those are kind of the prime things that attracted me to the space. And now we're off to the races.
Okay, so what is it about mining that's been proving attractive to a West Coast Silicon Valley tech mindset of investor? Perhaps you could tell us a little bit about some of the differences in mentality between a typical mining investor and the type of investors that you deal with and know about in the West Coast, and also some of the elements that have been attractive about mining to a different type of non-traditional mining investor, for instance.
There. Yeah, no, I mean, it's been hard. I'm not going to lie. There's actually a lot of similarities between kind of the VC tech game and the junior mining space. But at least to VCs, for the past 10 years, it largely goes over their head, which is unfortunate, but that's just the reality. I would say the similarities are pretty obvious. The good VCs make big bets. You know, if you're starting a small business, a technology business, and you can build it to 60, 70 million and sell it, that's great for you. That's great for the entrepreneur. But if you're one of these big VCs, that's not good enough. You want something that has the potential, if it works, you know, the probabilities are very low, but if it works, can be $1 billion or multi-billion dollar idea. And I think the same principle applies in the mining space. I mean, I'll just quote Ross Beatty is absolutely one of the top mining entrepreneurs, potentially ever, definitely living today. And he will tell you that there are just as much risks with small projects as there are big projects. The space is risky enough. Why don't you focus on large opportunities so that if you're lucky enough to get right, if the chips fall kind of in your favor, then you get a big payout. Because a lot of your bets, as smart and well-informed as they may be, simply aren't going to pan out for reasons beyond your control. So you really need to focus on those large-scale, world-class opportunities. So there's that parallel, and yeah, then there's just the VC mentality, especially if you're focusing on the exploration side of the game. You should expect that 80% of your holdings, again, no matter how well-informed the bets are probably not going to pan out. And so you have to be comfortable with losing most of the time. But of course, you need your winners to amortize those losses and to provide an acceptable rate of return for yourself and your investors. So there's those similarities there. I would say differences. Mining is far more capital intensive. I'll say that for sure. Tech, we've seen, especially with the creation of a bunch of SaaS software, the creation of cloud computing, you can get a tech company off the ground for cheaper than you ever could. Mining is capital intensive as it's ever been. And you're gonna have to spend millions, if not tens of millions, to make a discovery, and then tens of millions, if not hundreds of millions more, if you're lucky enough to have a high quality project to advance that to a construction decision, only then to spend hundreds of millions or billions to actually build the damn thing. So, and then you see your first cent of revenue. So I think that's one potential turnoff for VC types when they look at the mining space. A second turnoff would be just the disconnect between being publicly traded, right? The Silicon Valley model, especially over the past 10 or 15 years, this might seem a bit crass, but it's the truth as far as I'm concerned, is to keep these companies as private as long as possible. Jack up the private valuations as high as the market can bear, and then at the right opportunity, dump that onto an unsuspecting retail audience by IPOing the company and then exiting your position once it's IPO'd. Obviously, in the junior space, it couldn't be different. I mean, you have $2 million market cap companies. It's very common for a company to go public right off the bat with very little time being private. And so there's some disconnect there. Even at the end of the day, and I tell this when I'm talking to VCs about the space, at the end of the day, it all comes down to valuations. There's a share count and there's a share price. You multiply those two together, you get the company's current valuation. Whether that share price is public and it's changing daily, or whether it's private and it's kind of set in stone from fundraise to fundraise, it's still a game of valuations. And if you can find an opportunity that you think is worth X, either from an intrinsic value or speculative value, the valuation's down here. For all intents and purposes, whether it's public or private, the opportunity is still there. So there's plenty more I could share on some of the differences between VC tech investing and what we do here in Junior Resources.
Okay, so with the current bull run in gold and the sensational gold price that we've been seeing this year, do you feel then that that's going to encourage more of this generalist and sort of non-traditional mining finance, mining capital to come into the sector? And also with that, how do you view gold equities within your fund? Are you bullish on gold? Is gold your preferred commodity of choice?
I will say, Adam, it's easier with the wind at our back now, right? I think the narrative's been in place for a mining bull market for a few years now, and it's been a longer wait than many expected. But obviously with the metal price increases we're seeing and some of the speculative attention return to the juniors just over the past 8 to 12 weeks, that argument, as convincing as it may have been a year ago, is that much more convincing, because a lot of people just need to see price rises before they believe the narrative. It's just the way it works.
Okay, so let's talk a little bit more specifically about your fund, though. And what's your investment style? Do you specifically like gold producers, juniors with a bit more of an exploration risk around them, but potentially more value to be created down the line? What's the commodity angle? Take us through that a little bit, please.
Yeah, so funny enough, I'm pretty commodity agnostic. I will say at the moment, close to 70% of our portfolio is weighted to either gold or silver equities. So we do have a heavy weighting to precious metals. It's a combination of some tactical allocation decisions as well as just outperformance amongst the gold and silver focused names within our portfolio. That's a bit high for us. Where we are in the cycle right now, I'm comfortable with that, but I will say definitively this will never become a precious metals only fund. As easy as it would be to raise money with that kind of mandate, I think this sector is risky enough and tricky enough where if you confine your opportunity set to just a couple metals, you're creating a lot of unnecessary risk and then also potentially missing out on other investment opportunities. Yep. So yeah, I'd agree firmly that we're in a precious metals bull market. Whether you want to say it's been going on for 5 years since 2016, or really has gotten into gear, since spring of 2019, where we broke above that key 1375 technical level. That's kind of semantics at this point, but yeah, we're firmly in a bull run here. And I think it's nobody knows how long this is going to last, right? So I can say pretty confidently that I think we have a good 12 months to go, maybe 18 months to go. Beyond that, I hope I'm wrong. I hope this lasts for 3 or 4 or 5 years. And either way, I think there's a lot of money to be made. I think the duration of the cycle, though, will depend somewhat on the behavior of both companies and investors. And I think it's important to stay disciplined. Obviously, as the euphoria continues to crescendo, it's my message is going to fall more and more on deaf ears. But from the kind of producer side and the potential acquirers, obviously we've seen a lot of M&A activity over the past 12 or 18 months. And so far, most of the deals have been high quality. There's either been synergies between the acquirer and the acquiree, or it's just high quality assets that make sense and work, at $1,300, $1,400, $1,500 gold. I think where we get into trouble in this industry is when you have the larger producers making acquisitions with the assumption that metal prices are going to rise forever. And we certainly saw that in the last cycle, where the big, especially in the precious metal side of things, the big gold producers took on massive amounts of debt, bought large, low grade, highly capital intensive projects that, have really attractive numbers at $2,500, $3,000 gold. But as we know, this industry goes in fits and starts, and there's no straight path from one gold price to another. So I really hope on the producer side of things, they can stick to high quality acquisitions that work at gold prices 20 or 30% below where we're at right now. If the gold price keeps rising, then great, that's gravy on top. But I don't want the producers to repeat the mistakes that they made in the last cycle. And then in terms of the investment class, we need to be smart. Focus on ethical teams, focus on teams that have been through multiple cycles, focus on teams that have been busy for the past 10 years, advancing their projects through really tough times, and not the guys that have been doing crypto and blockchain. So I think there's a lot of responsibility on both sides of the table for us to stay disciplined. And I think if we do that, this cycle will be more sustainable and less of a sugar rush like we saw, in 2016, or like we saw between 2009 and 2011. It'd be really nice for this to be drawn out over a few years, even half a decade, versus just a 12 to 18 month pop followed by a pretty painful hangover.
Okay, and aside from gold or precious metals, are there other metals that excite you and that you'd like to present to your investor base through or show attractive prospects over the next sort of 5 to 10 years?
Absolutely. So again, pretty commodity agnostic. So when I look at a given opportunity, it's always the people first. I just have a strong belief that the further you go down the value chain, the more important the people are. You could put a mediocre CEO in charge of Apple or Amazon or Google, and those companies would be fine for 3 to 5 years. They got a lot of momentum behind them. But if you're in the junior space, exploration stage, development stage, projects, I mean, you're making life or death decisions, if not on a weekly basis, then every couple months. So you really need people that are properly incentivized to do the right thing and have done it before and have that support network to fall back on if there's tough decisions to be made. So people first, are they properly incentivized? Have they done this before? Then you want to look at the asset. If I'm looking at the asset, I want to look at spot metal prices or even below spot metal prices. So I do have some biases to particular metals, and I'll get into that in a second. But when you're evaluating a given project, I don't think you want to be plugging in metal prices that are above spot price. There's maybe a few exceptions, uranium being one of them. But for all intents and purposes, we want projects that will work at the current metal price. And if metal prices go crazy, then great, that's gravy on top. Maybe we won't get quite as much leverage as some of the large optionality plays, but that's just fine with me. I think it's a slightly less risky game to play. And then if you're in the exploration or post-discovery phase, it's hard to know, of course, whether the project works at current metal prices because the project's still being defined. But you want them to be working in a geological context. You want to be seeing results that could indicate, hey, this could make sense. This is not just going to be something large that's low grade, that looks great on paper, but it's never going to be built. This is something that if they continue along this vein, they could build. In terms of, my bias actually, funny enough, has always been towards the battery metals, the metals that help us live our 21st century lifestyle. The nickel and the cobalt and the lithium that are going into our batteries, our EV batteries, or the vanadium going into our grid storage batteries. The rare earth metals going into our wind turbines, the silver that's being used to capture electrons from the sun in our solar panels, the uranium that's feeding our nuclear power plants. That's the only form of baseload power that can go 24 hours around the clock, no sweat, without any CO2 emissions. So funny enough, those were the metals that really attracted me to the space to begin with. And gold, because 90% of it, in my mind, isn't put to good use at the end of the day. It is a barbaric relic in a lot of ways. It's either going into coins, bars, or jewelry. To me, that's either fear or vanity. That's not too interesting to me. Only 7%, 8% of gold is actually going into industrial uses. So funny enough, that's a metal that I'm less passionate about. That said, I very firmly understand the value proposition in a world with high volatility, a lot of money being printed, and interest rates nominally near or below zero, and real interest rates across the board zero. So don't get me wrong, I think I like where we're at gold-wise, but it's not really the metal that drew me to the space originally. I'm not a gold bug by nature.
Yeah, understood. So you talked a little bit about exploration risk there. What sort of stage companies do you like? Would you like to diversify the portfolio, hold some producers and some riskier assets? Or do you see there a great deal of return in the earlier stage projects or the non-producing assets at the moment? Do you think that's where value is to be created as an investor into this space?
It's a great question. We're very much early in the value chain, I would say. Funny enough, we only have one producing miner in our portfolio, which might blow people's minds, and it's not a precious metal producer. So we own none of the big miners, none of the mid tiers. Our cash flowing names are either royalty companies. So our producing cash flow names are almost always royalty names. We do have a couple farming companies in the portfolio that are making money from a more traditional sense. But in terms of our mining names, if it's not royalty, then it's probably not making money. In terms of kind of the stages we look at, if it's pre-discovery, I'm very reluctant to bet on a single asset. I prefer the prospect generation business model. It's definitely been a tough 10 or 15 years for that business model. There's a lot of controversy whether it works. Is it dead? Personally, I think it works. Again, that business model was designed originally to avoid dilution, just like the royalty model. And I think I would much rather have multiple shots on goal, high quality geological teams that can scout out prospective terrain, have the ability to secure the tenure, have the ability to advance it as far as possible without drilling, and then have the credibility and connections within the industry to bring in partners to spend their own money. And if there's a big prize there, 20 to 25% of a big prize when you're a 10 or $20 million prospect generator is a big deal. So I'd rather get less greedy. To me, it doesn't matter if you own 100% of the asset. discoveries are hard, and I'd rather have as many shots on goal as possible. That's why I like that business model pre-discovery. We also look at post-discovery plays. This is quite a popular model or kind of a mode of investment right now. These are companies that have been drilling a project, maybe successfully, maybe not, and then suddenly they hit a hole where the market goes, wow, this can be economic. Look at that width, look at that grade. It looks like it's open, laterally or at depth or both. They're potentially onto something big here. So I'm pretty, I don't jump into these all the time, but when we do, it's worked out well for us. Adriatic Metals is one of the names that became a post-discovery investment for us. We saw their initial drill hole in mid-2018, where they hit 64 meters of 26 grams per ton gold equivalent, just mind-blowing hole. And within 6 weeks, I'd gotten comfortable with the investment. We decided to initiate an investment, and here we are a couple years later, and we're looking at one of the top polymetallic development plays in the world, and a company that most likely is not going to be around 6 or 9 months from now, in all reality. And so that model has worked for us. And then just quickly, kind of the third basket we'd look at, kind of pre-cash flow, would be the high quality development projects. Something that like Adriatic has turned into project that's low capital intensive, has an NPV well in excess of the initial CapEx, has an IRR hopefully above 30%, quick payback, a long enough mine life, something that a major company would want to come in and buy and then take into production.
Okay, excellent. So just tying this back into the state of play in the current market and the current geopolitical issues going on, has COVID-19 and market downturn impacted the way that you go about conducting your investments, the way that you conduct your process, your due diligence, the way that you meet with companies? Has it had any knock-on effects there?
That's good. It's a good question. I mean, I would say no, we haven't changed all too much. Like the focus for me is always going to be the people. When I look at an asset, it's always going to be plugging in current metal prices or metal prices below. I'm never going to be speculating on $3,000 gold or $4 copper. As much as I believe we could see that in the coming years, the market timing is just not my game. And to me, it's better to just focus on the higher quality projects, even if you're giving up a little bit of upside, even if you're giving up a little bit of leverage. But in terms of the general marketplace, obviously the COVID-19 crisis has shaken up a lot of people. And I think that's part of the reason we've seen this flight into precious metals here. I mean, it's really been a strong 12 years for the US over the world. It's been a strong 12 years for growth over value. I think the jury is still very much out, whether copper, whether zinc, whether nickel, whether the ag minerals, whether agriculture in general is going to follow on the heels of precious metals, or whether it will lag behind for another 12 or 18 months before picking up steam. There are a few, technical levels to look at. If we see copper pop, convincingly above $3 per pound, if we see oil jump above $45 per pound, per barrel, there are certain key technical levels that have yet to be broached for kind of the industrial and energy metal space. So I'm watching that somewhat closely. To me, I'm a bit indifferent, and in a weird way, I'd almost prefer for the precious metals to kind of ride on their own for 12 to 18 months here, because that will give us a good opportunity to kind of take profits on the way up without trying to call the top perfectly, and kind of redeploy into these metals that I think have a good run ahead of them, but I'm just not sure if it's started yet. So, but that said, I don't want to get too greedy. The market doesn't care what I want. If this does turn into a broad-based commodity bull market and we see copper take, off to the races without a pullback again down to 2, then great. We're well positioned for that. But I'm still a little hesitant on where we are in the cycle, looking beyond the precious metals.
Okay, with that then, how do you see junior stocks valuations at the moment? And do you see the valuations starting to creep up? Or are you finding that there's still quite a lot of good, well-valued opportunities out there?
Oh, I think so. Yeah, I think so. I mean, nowadays you're starting to see the euphoria, and that always concerns me when companies just by virtue of having gold or silver in their name suddenly start to catch a bid. You see the Vancouver paper mill up and running at full capacity now. It seems like there's a new financing closing every hour, a new company listing every other day. And there's a lot of people that are, turning shells into precious metal codes. And, I think we're still early in the process, but when you start seeing that, you're like, okay, we can see the finish line in sight here. And so, yeah, I just want to be cautious, and hopefully investors that are listening to this can avoid the promotes. Like, we want to get rich as investors. We want to get rich alongside management teams, right? Let's not make management teams rich. Let's not get into stories as cool as they look on paper, as sexy as the narrative is. The management team's up 10x on their investment already, and there hasn't been a significant catalyst since they founded the company. What's the point? Let's get in alongside the management teams at similar levels to where they've invested their own money. And have they invested their own money? More than half of these deals, maybe in the vast majority of these deals, they're not putting up a cent. It's a bunch of cheap option paper, at 2 or 3 or 5 cents, and you have them listing at 40 or 50 cents. And we're seeing a lot of kind of unsuspecting retail investors follow in. And while there's potentially money to be made, quick money to be made in the short term, I just think it's a bad investment practice. You leave yourself out there when the cycle turns to just get absolutely hammered. And as I emphasized kind of earlier in this interview, I think you're actively contributing to this cycle being shorter and less sustainable than it would be otherwise if we just stay disciplined and back good people. That's what we got to do.
But what would you say is giving you the most challenge at the moment? What might be keeping you up at night as you navigate investing within the junior mining sector?
Absolutely. Well, I would say it's the speed at which the cycle is progressing, at least on the precious metal front. I've just been shocked. I think everybody has. Even just the past couple of weeks, you saw that sentiment was at basically maximum positive sentiment in early July. And a lot of the smarter technical analysts were saying, hey, we're going to have a pullback here. I guess another concern is just the amount of new companies that are being created, right? Because that dilutes capital from the higher quality names. And if you have a financing coming up left and right, and they're subscribing 10, 11, $12 million per deal, which seems to kind of be the status quo at the moment. Some of those deals are good. Most of them aren't, though. And that's money, that's real investor capital, that's not being allocated to some of the higher quality names that have been around, have been through the ups and downs of the cycle, that have actually been able to keep their companies intact and advance their asset at whatever stage it is through the tough times. So that's a concern for me, that while there's a lot of money flowing into the sector, Bay Street has the ability to make a new company, every day, it seems like. And so I just don't want investors to get overly diluted, and for the quality of the overall junior industry, which even at the troughs of bear markets, as dubious as is, to dilute even further, right? At the peaks of these bull markets, you have to assume 80 to 90% of these companies are untouchable and run by people that you never want to trust your own money with. So when you're thinking about investing in a management team, I'm sorry to keep going back there, but don't think of this as a quick opportunity to make a buck. Think of this as, is this somebody that you'd open a local business with? Is this somebody you'd open a brewery with and that you'd invest alongside? Is this somebody that you would trust with your own family capital, assuming that you'd have to lock it up for a few years? I think that's a really good lens in which to evaluate management teams and whether a certain investment should be made.
Absolutely. Fantastic. Well, look, that's about it. Thank you very much, Matt, for joining me. That's Matt Geiger from MJG Capital. And thanks for watching.
Yeah, this is really fun, Adam. Thanks for having me.